Imagine something for a second. Picture this. You've spent 20 years of your life, your blood, sweat, and tears dedicated to a single company. You show up early, you stay late, you grind through weekends when the deadlines get tight. And because you genuinely believe in the mission, because you bleed the company colors, you invest a massive chunk of your 401k directly into the company's stock. You feel loyal, you feel smart, you feel secure. But then overnight, the unthinkable happens. The company collapses. You walk into the office the next morning, and instead of your morning coffee and your usual routine, you're handed a cardboard box and a pink slip. Just like that, you've lost your job. But here's where the real nightmare begins. You pull out your phone, log into your retirement account, and you watch in horror as you realize that your life savings, your entire nest egg, has vanished right alongside your paycheck. Now, I wish I could tell you this was some made-up worst-case scenario. It's not. This is exactly what happened to thousands of employees at companies like Enron, WorldCom, and Tyco. Real people, real families, real devastation. Today, we are going to blow the lid off what I call the company stock casino. We're going to dig into the dangerous psychological traps that convince otherwise brilliant people to bet their entire financial future on a single employer. And then I'm going to hand you the exact Wealth Guardian blueprint to legally untangle your wealth and secure your legacy before the house of cards comes crashing down. Simple. Protect your wealth through education. We take complex legal and financial jargon and translate it into practical, real-world strategies you can actually use. If you're serious about keeping what you've worked so hard to build, do me a favor right now. Hit that like button, subscribe to the channel, and ring the bell for notifications. Those 3 clicks cost you nothing, but they help this channel reach more people who desperately need this information. And I also want to strongly encourage you to watch this video all the way to the very end. The final strategy I'm going to share with you, a highly counterintuitive tax maneuver involving what to do with your company stock when you leave your job, could literally save you tens of thousands of dollars in unnecessary taxes. I'm not exaggerating, so stick around. Before we go any further, the standard but important reminder: everything in this video is strictly for educational purposes and does not constitute personalized legal or financial advice. Everyone's situation is different, so always consult a qualified professional before making decisions about your specific circumstances. All right, let's get into it. Here's the staggering reality. Millions of American employees have allowed their company stock to turn what should be a prudent, diversified investment portfolio into what is essentially a high-stakes lottery ticket. And the numbers back this up. When researchers surveyed the 401k plans at some of America's biggest corporations, they found that an alarming amount of the money in those plans was parked directly in company stock. At certain companies, employees held more than 80 and in some cases more than 90% of their entire retirement savings in their employer stock. Think about that for a second. 90%. That is not investing. That is gambling. And here's the thing that makes this so dangerous. Your employer already controls your paycheck, your health insurance, and in many cases your daily schedule. When you also hand them the keys to your retirement savings, you've essentially put every egg you own into one single fragile basket. So, the obvious question becomes why? Why do so many smart, hardworking people make such a potentially catastrophic financial mistake? Well, it comes down to 3 powerful psychological traps, and understanding them is the first step to breaking free. Trap number 1, familiarity that incorrectly breeds confidence. Here's how it works. You drive to the same building every day. You know the products inside and out. You like your coworkers. You see the CEO on the company intranet talking about growth and innovation. And because of all that proximity, your brain tricks you into believing that you have some kind of insider edge, that you truly understand the financial health of this company better than the average outside investor. But here's the harsh truth. The real financial condition of a large corporation is often buried in layers of complexity that exist far above your pay grade. Accounting irregularities, off-balance sheet liabilities, pending litigation, executive misconduct. These are the kinds of things that can sink a company overnight, and the rank-and-file employees are almost always the last to know. Just because you work for a company does not mean it's a safe place to park your retirement period. And let's be honest, corporate America loves it when employees invest in their stock. It promotes loyalty, it supports the share price, and in many cases, employers quietly reinforce this trap by matching 401k contributions exclusively with company stock. So right from the start, the deck is stacked. Trap number 2, groupthink. When you work for a company, you're surrounded by people who are all rowing in the same direction. And that creates an environment where you become highly susceptible to a phenomenon psychologists call groupthink. Groupthink happens when an entire group, in this case your office, conforms to a prevailing point of view and collectively ignores critical analysis, dissenting opinions, or glaring warning signs. If your boss is loading up on company stock, if your cubicle neighbor won't stop talking about how the share price is going to double, if every team meeting starts with a celebration of the latest earnings beat, you are going to feel immense social pressure to follow the herd. And if you want to see groupthink at its most destructive, look no further than Enron. At an all-employee meeting in late 1999, a senior Enron vice president stood in front of the entire workforce and explicitly encouraged every employee to pour their 401k money into Enron stock. He boldly predicted a massive increase in the stock price over the next 12 months. The crowd went wild, swept up in that collective euphoria. Enron employees ultimately had nearly 58% of their retirement savings concentrated in Enron stock. And then, as we all know, the stock dropped almost 99%. Those loyal employees, people who had done everything right, who had shown up every day, who had trusted their leadership, lost over $1 billion in combined retirement assets. Careers destroyed, retirements wiped out, lives shattered, all because groupthink silenced the voice of reason. Trap number 3, and this one is incredibly sneaky, cognitive dissonance. Here's the deal. If you spend 40 or 50 hours a week pouring your energy, your creativity, and your talent into a company, your brain has a very strong need to believe that the company is worthy of that sacrifice. You want to believe it's strong. You want to believe it's ethical. You want to believe the stock is a winner. So what happens when you hear negative news? What happens when a bad earnings report drops, or an analyst downgrades the stock, or a whistleblower raises red flags? Instead of objectively evaluating the information and protecting your wealth, cognitive dissonance kicks in and makes it incredibly difficult for you to accept the truth. Because selling would mean admitting that the company you've dedicated your career to is actually a terrible investment. That's a painful realization. So instead of acting, you dismiss the warning signs. You rationalize. You tell yourself it'll bounce back. Management has a plan. The analysts don't know what they're talking about. And just like that, you protect your peace of mind while leaving your portfolio completely exposed. Now, when you fall victim to these psychological traps, you set yourself up for what I call the ultimate financial disaster, the double whammy. Here's how it works. When too much of your financial life is tied to a single employer, your salary, your benefits, and your retirement savings, you've created a massive single point of failure. If your employer's industry falters, your risk of getting laid off skyrockets, and at the exact moment you lose your job, when you're most desperate, when you need to tap into your investment accounts just to keep the lights on, you'll likely find that your company's stock has plummeted to a fraction of its former value. You lose your income and your savings at the same time. When it rains, it pours. Let me pause right here and ask you a direct question. Have you ever actually logged into your 401k or your brokerage accounts and calculated exactly what percentage of your net worth is tied up in your employer's stock? Are you relying on the same company to fund your paycheck today and your retirement tomorrow? Drop a comment below right now and tell me your honest answer. I want to get a real conversation going in this comment section so we can learn from each other's experiences. I read every single comment, and I'm telling you, recognizing this vulnerability is the absolute first step to protecting your family's future. All right, so how do we fix this? How do you safely divest from the company stock casino without alerting your boss or triggering a massive tax nightmare? It's time for your Wealth Guardian action plan. 3 steps. Step 1. Enforce the 10 to 15% rule. You need to establish a hard ceiling on your exposure. Here's what you do. Add up the total value of all your restricted stock units, your stock options, any shares you've purchased through an employee stock purchase plan, and the company stocks sitting inside your 401k. Now compare that total to your overall investable net worth, and I'm talking liquid assets here, so exclude your primary residence. If your company stock exceeds 10 to 15% of your total liquid net worth, you are dangerously overconcentrated. Full stop. You need to work with your financial advisor to begin systematically selling those shares and reallocating into a diversified portfolio. Start with the stock inside your 401k, because that's usually the easiest to move without restrictions. Step 2. Hedge your industry. Now, I know what some of you are thinking. That's great advice, but I can't sell my stock. I'm an executive in a blackout period, or my options haven't vested yet, or I've got lockup restrictions. Fair enough. If you're restricted from selling, you can still protect yourself by hedging your exposure to the broader industry. Here's the logic. Companies within the same sector tend to move together. They're affected by the same economic forces, the same regulations, the same consumer trends. So if you work for a booming tech company and you're sitting on a mountain of their stock, You should immediately direct your financial advisor to reduce your portfolio's exposure to other technology stocks. Don't double down on the same sector. And if you want to get more sophisticated, you can even have your advisor establish short positions against your direct competitors or against an industry-specific ETF or index. That way, if the entire sector takes a hit and your company's stock drops, those short positions will generate gains that help offset your losses. It's not a perfect hedge, but it's a meaningful layer of protection, and it's far better than doing nothing. Step 3, and this is the one I told you to stick around for, the NUA tax trick. NUA stands for Net Unrealized Appreciation, and if you hold highly appreciated company stock inside your 401k, this strategy could save you a fortune when you leave your job or retire. Here's the conventional wisdom. When you separate from your employer, you roll your entire 401k into a traditional IRA. Simple, clean, and that's what most people do. But if a significant portion of your 401k is company stock that has grown substantially in value, rolling it into an IRA is often a massive, expensive mistake. Here's the counterintuitive move. Instead of rolling that company stock into an IRA, you transfer it directly into a standard taxable brokerage account. Now, I know that sounds insane. Taking money out of a tax-sheltered retirement account and putting it into a taxable account? Why would you ever do that? Here's why the math works. When you move the stock out of your 401k, you only pay ordinary income tax and potentially a 10% early withdrawal penalty if you're under 59.5 on the cost basis of the stock. The cost basis is simply what you originally paid for those shares, not what they're worth today. Let me give you a concrete example. Let's say you accumulated company stock in your 401k at an average cost of $15 a share over the years. Today, those shares are worth $150 each. Under the NUA strategy, you only pay ordinary income tax on that original $15 per share. The remaining $135 gain, that's the net unrealized appreciation, is not taxed until you eventually sell the stock. And here's the kicker. When you do sell, that gain is taxed at the long-term capital gains rate, which currently maxes out at 20% for most high earners. Compare that to ordinary income tax rates, which can run as high as 37% at the federal level. You could be looking at a tax rate difference of 15 to 17 percentage points on potentially hundreds of thousands of dollars. That is a game-changing amount of money that stays in your pocket instead of going to the IRS. Now, this strategy has specific rules and requirements. You need a qualifying distribution event. You need to distribute your entire 401k balance in a single tax year, and there are other nuances, so please work with a qualified tax professional before you execute this. But if you qualify, the NUA strategy is one of the most powerful and underutilized tax planning tools available to American workers. Here's the bottom line. Loyalty to your employer makes you a great worker, but blind loyalty to their stock makes you a vulnerable investor. You do not owe your company your life savings. Intelligent investing requires you to look at your portfolio objectively, separate your paycheck from your nest egg, and build a diversified fortress that can survive any corporate scandal, any industry downturn, and any economic storm. I want to hear from you. Head down to the comments right now and tell me, are you going to calculate your company stock exposure today? Are you going to look into the NUA strategy before you roll over your 401k? Let me know. If you found this video valuable and you're committed to protecting your financial legacy, hit that like button, subscribe to the channel, and ring the bell so you never miss our weekly wealth protection blueprints. Remember, building wealth is hard, but keeping it is hard. Long-term financial security is a reality only for those who plan, verify, and refuse to gamble their retirement in the company casino.